Hey there, I'm Jim Munchbach with Bayrock Financial, and today I want to talk about one of my favorite investment strategies. It's a covered call strategy, and I'm going to use ExxonMobil as the underlying investment for this strategy. So we've got some clients who own a good number of shares in ExxonMobil. I also like to invest in ExxonMobil from time to time, and ExxonMobil, XOM is the ticker, is an excellent company to invest in using this strategy, and I want to explain a little bit about why. So first thing I want to do is just jump into a chart with ExxonMobil. So you'll see I've got this chart of ExxonMobil, and we will be looking at this chart. I'll expand it in a minute and show you what we're talking about. But first I wanted to just go through a few terms. Excuse me. Covered call, that is the type of option strategy that I'm going to be unpacking in this video, and I'm going to be doing a bit of a series because I want to help my clients understand what the strategy is, how it works, and why we recommend it as a way to manage risk and produce a reliable income stream. ExxonMobil is an excellent candidate for a lot of reasons. And number one is it's a very liquid stock. It has a huge volume, trades a lot of shares. It has a razor-thin spread between the bid and the ask, and it has a very active options market. So you're never going to get stuck unable to sell or buy an option or close a position. So that's one of the reasons among many that we like this particular underlying investment for this strategy. So that's a covered call. Let me just try to jump on over, and I'm going to do this. I'm just going to show you, this is the ExxonMobil stock. You can see here that we've got a 6-month chart open, and so let me just take that to a 2-year chart just to get you familiar with what we're looking at in this stock. So this is a 2-year. You can see that's a 2-year right there, 2-year chart. And this is ExxonMobil, so you can see that it trades in a pattern, and in the last couple of years, in the last 6 months for sure, I would say it's in a pretty consistent pattern. So if you look at the highs and the lows for that stock, you can see that it's in this channel, and it hits the upper level. And at that point, when it gets to that upper level, that's a good time for us to sell or write a call, and that's what we'll be talking about for the next few minutes. So that's a covered call. When you own a stock and you sell a call, it's a covered call. It's the lowest risk options strategy there is, and it's the only option strategy we typically recommend to clients, but it is, for many reasons, one that we like. So let me get rid of those marks there. So the next thing I want to mention is the strike price. So when you look at that chart, you'll see that the price goes up and down, and the strike price is something that we designate when we write a call option. So the strike price is important. We want to typically wait until the stock is at the upper end of that level, that pattern, and then we would sell with a strike price that is a couple dollars out of the money. So what we don't want to happen is have that underlying stock called away. We get premium. We get paid a premium. So if you look at this video is being posted in an article called the XOM Covered Call Strategy. And so as you scroll through this article, you'll see that we've created an example using ExxonMobil, and we've let me get rid of this and just show you let me show you this article. This is just the article. I posted this post at Bayrock Financial. So I think my camera's off center. Anyway, this is where you'll find all of the information that I'm talking about in this video. And you'll see that I've created an example, and this is simply to illustrate how this strategy works. This is for educational purposes, and I would not rely on these numbers. This is just to educate you and help you understand how this strategy works. So I went back to January 2018, figured out the price of the stock at that time, and then back tested the strategy just to have something to look at for this video and for this strategy. So again, this is hypothetical, and you can't rely on these numbers, but they do give you a good idea of what we're trying to accomplish in this strategy. So again, we'll go back to the list of terms that we're working on. The premium is what you get paid when we sell that. So the market's closed at the moment. It's Saturday, and so I can't show you actual numbers, but I will do that in a future video where we will kind of walk through this strategy multiple times, because it is a rinse and repeat type of strategy. We get paid this premium every time we sell a new call contract, a new call, and we get premium for that. And our hope is that when we look at this stock, when we look at ExxonMobil, our hope is that this my iPad's wanting another verification. So our hope is that we set the strike price high enough so that the stock never gets called away, never gets exercised. But if it does get exercised, typically we're running this strategy in tax qualified accounts, which makes it work really nicely in terms of creating an additional stream of income in addition to the dividend that this stock likes. This ExxonMobil provides a very consistent dividend. So we don't want the call, we don't want that option, we don't want to get called away, have it exercised. If that happens, we will just turn around and buy the stock back. So typically, if it gets called away, if we work the strategy correctly, and that's my intention, to make sure that we pay very close attention to the ex-dividend dates so that we don't ever not own ExxonMobil when we get paid that dividend. So we have to own it on the ex-dividend date. So that's part of the strategy. So the premium, the expiration date, and I mentioned exercise. Exercising is what happens if the stock goes up in price before the expiration, and if we're in the money, if we sell a call option, so we're the writer, we write a call option, someone else buys it, and so they control that option, and if they decide to exercise it, which they can do, they can exercise their call option that we sold to them and they bought from us, giving them the right to exercise the option. They can exercise it, which means they would then be able to buy ExxonMobil from us for the price, for the strike price, if it is a penny above that strike price on or very close to expiration. So that it usually has to be way in the money for it to be exercised early, but that can happen. So that's one of the risks that we face when we're doing this strategy. So let's take a look at, I've got another number of terms that I just want to mention in this video. Out of the money, that is, the price of the stock is out of the money if we set so Friday, ExxonMobil closed at 113.50. And we have an ex-dividend date coming up, so I would not want to write a call option today or Friday with the price of ExxonMobil at this level, because at this level, we would have a pretty good chance that the price of the stock would go up. And if we hold that option, we get paid the premium. Someone else gets to exercise it. So if the stock price goes up, we would get called away. So I would not want to write the calls on a day like today. I'd wait until we get to that upper end of that level. And again, that it's got a pretty good channel there. You can see it's pretty consistent. So that's what we would do. We would wait until the value goes up, and then we would sell the call, paying again close attention to where the where the ex-dividend date is. So we don't ever want to not own the stock when the dividend is paid. And so you have to own the stock on the ex-dividend date. So I keep a list of that. So out of the money means it's out of the money. We would then get to keep the premium. That's the goal. That's what we were trying to do, is just get paid the premium by selling those call options, rinse and repeat. Every 4 to 6 weeks, we would sell that option. And if it's in the money, that's where we get close to getting the risk of having the stock called away. So that's when that happens, I'm paying close attention to this contract each time we do it. Again, the premium, that's what we get paid. That's like the reason we do this, is to create a premium. So if you look at this article, you'll see in this example that I wrote here, you can see the premium calculation for the year, assuming we can do, in this case, I just assumed we owned $1 million of ExxonMobil starting in January 2008. And then we would be basically repeating this strategy 8 times throughout the year. And we used $1.50 per contract. It would be more today because the value of the stock is more. But just to give us an idea, that would give us about $138,000 in this portfolio that holds only ExxonMobil, $1 million worth. So that's the kind of returns we would be looking for. And you can see that we just take this same strategy. In this article, I just used an example to show repeating the process over the years and back testing it from 2018 to 2023. And the reason I chose those years is because this season has been very unusual in my experience as an investor, as a person who manages investments. So oil and energy stocks have been interesting and somewhat volatile throughout the last 10 years, but in the last 5 years for sure as well. So anyway, just what I wanted to do is get a sense of, if we're in a bull market, if ExxonMobil is in a very strong uptrend because we're in a bull market, then we have much more sensitivity to being called away. But if we're in a downturn, then we just get paid that premium, and we're basically making money. And if the best way to explain this, or the best reason that I like this strategy, is because just imagine in this pattern, if we did this pattern for 2 years or 3 years or 5 years or 10 years, what happens is, we repeat this strategy over and over, and the stock goes up and the stock goes down. And you wouldn't really make a lot of money on owning ExxonMobil if it did that, if it stayed in a pattern for multiple years. But you would make an additional significant amount of income if we would do this strategy over those years, and if we just continued to do it over and over and over, which is what we plan to do. So back to the list of terms. The premium is what we're trying to get in this whole strategy, which was what creates an additional stream of income for your portfolio, which is the whole reason we do it. Theta decay is my favorite term in options. I studied options. I learned to trade options from a guy named Tom Sosnoff. So if you're listening, Tom, thank you very much. Tom was a great instructor. He took us to the Chicago Board of Options Exchange, and that's where we had like our final exam. And I learned a lot in that course. That was, a long time ago, maybe 20 years ago. But I've been trading options for all these years and learning. And there were 2 words. When Tom boiled down, Tom Sosnoff, for our group anyway, when he boiled down the ultimate lesson, he boiled it down to 2 words. He said, sell junk. That may sound odd, but what he was telling us, what he taught us is, the probability for success in options is with the high probability of success is with the person who sells the premium, who writes the options. And so and the reason for that is because of this major component of options pricing, which is called time decay or theta decay. So if nothing happens to the price of that stock and you sold a call, the price decay on that option allows you to make money, and that's the key. So I don't want to get too deep in the weeds on how this works, but trust me when I say that selling junk, Tom was right. It is the high probability way to make money with options, and the covered call strategy is based on that one simple idea: sell junk. So the selling of time decay, selling an option that's out of the money and doing it when the price is at the upper level, is just a high probability trade. And so that's what this is. The next thing I wanted to just mention was rolling. So we will roll these options. So we could just close out a position and write a new position, or we could roll it. There's a number of ways to do that, and our trading software allows us to do that. So that is pretty much what I wanted to cover. And again, this is the stock. So let me just kind of show you a couple of things before I end this video. That's a 6-month chart. We look at a 2-year chart, a 5-year chart. We could go all the way up to a 5-year chart right there. We'll go to 5 years. Now, I think we got 5 years. No, we still have 6 months. Let me get to 5 years. There we go. Now we should be at 5 years. And so if we just open that up, you can see the price movement of ExxonMobil for 5 years. That's a monthly chart. So one of the reasons I like this stock for trading this strategy is just because it's a pretty reliable stock. The price pattern it's not like NVIDIA. It's not like several of the ETFs we use this strategy in. And volatility can help make this strategy more profitable. It's just a little bit more work, and you have to pay close attention to the strike price and the expiration and so on. And I will be doing that for the clients who choose to exercise this strategy in their portfolio. Again, this is just a kind of a first video. I didn't mean to go on so long. It's been about 17 minutes. I will do some more videos just to add to this series to educate you on why we use the covered call strategy to generate income in your portfolio. And if you have some specific questions or anything that I can help kind of clarify, do let me know, and I'll be happy to do another video for that purpose. So I am going to end it now, and like I said, I'll be doing some more of these in the future. Check it out at bayrockfinancial.com, and you can also usually I go live. I'm not live right now. I say I'm live streaming. I could be, but I'm not. I could be. I should be. It's so much easier to live stream. Like this video was done live with no edits, and so typically I live stream so that it's automatically on my YouTube channel. This one I am just going to go ahead and hit the finish button here, and then I'm going to upload it to my channel. But it will be in the Bayrock. There's a lot of playlists on my channel, and this one will go into the investment strategies playlist. So if you like YouTube, feel free to hit the like button and subscribe to the channel if you want to be notified when I post these videos. So I'm going to finish, and I'll see you in the next video. Thanks for watching.